and welcome to the Morningstar series, Ask the Expert. I'm Emma Wall and I'm joined today by Jackie Choi, Director of ETF Research for Asia, Morningstar. Hi Jackie.
Thanks for having me, Emma.
So next month, MSCI, the indexes, will be announcing whether they will be including China A shares into the MSCI Emerging Markets and MSCI China indices. If they go ahead, that'll come into play in June 2017, but what will the impact be for investors?
So if that would be included, China A shares would be accounting for 1.1% into the MSCI EM index going forward, and then like 4% in the MSCI China index. So that would be another sort of asset inflows into the China A share market.
And of course, this will affect anyone who has an ETF or tracker fund that tracks either of these indices, but it'll also affect active fund managers and active fund investors, because those fund managers will have a much bigger pool of shares from which to choose from, and they'll have greater exposure potentially to that market.
That's correct. That's why investors should be watch out for that event.
And last year, in June 2015, they made a decision not to include China A shares into those indices. Why did they make that decision?
So MSCI mentioned a few sort of obstacles that they think China equity markets should sort of evolve into before making a decision to include them. There were three sort of items that they talked about. Number one is the quota application process. Second is the capital mobility, and the third one is the beneficial ownership. So in the last 12 months, the market has been seeing a lot of changes in the market, including some of them which impact these three sort of obstacles.
And those concerns are the sorts of things that people often talk about when investing in China. The liquidity aspect, the fact that our shareholders, the priority for these companies. Mm-hmm. And you say those changes have been made. Mm-hmm. So what's the likelihood then of next month MSCI deciding to include China A shares in these indices?
Well, I can't say whether or not they will, but let's watch out for it. But the changes that the Chinese government have made, for example, they've make Q3 quotas more mobile, adding more quotas for the investment firms, as well as reforming the actual scheme as well.
So QV, for those people who don't know, it's this asset matching program, isn't it? Which means that asset managers can invest in China as long as they have equal assets out of China that sort of matches the amount they want to invest in China.
That's right, yeah, in a sense, yes. Yep.
And so with that improved, with the market becoming more open to international investors, you think this will be a positive thing for MSCI?
That will be, because this is one of the key concerns that I think not just MSCI, but a lot of the asset investors are actually concerned about whether my money can get into the China market and get out of the China market. Especially ETFs, if you look at the redemption creation process, you need money to get in, get out, to effectively to allow the ETF to work effectively too.
Because of course ETFs are traded on the stock exchange and they need to be liquid and they need to be tradable.
That's right, exactly. And also for the active fund managers, they need to get in and get out at the time that they want it.
So I suppose it's watch this space.
That's right, yep.
Jackie, thank you very much.
You're welcome.
This is Emma Wall from Morningstar. Thank you for watching.